Okay, good morning. Today we are going to finish up Chapter 5. Before we get there, we do have a question out in Learning Catalytics. It will stay open for a minute or two, so I'm going to go over the question, go through the answer. It relates to Monday's information, and that it will remain open for a minute or two, but it's not going to be open for very long, so you want to make sure you get logged in. The question is, a business offers credit terms of 115 net 30. These terms indicate what? Okay, so make your choice between A, the total amount of the invoice must be paid within 15 days. B, a discount of 1% can be taken if the invoice is paid within 15 days. C, the buyer can take a 1% discount if the bill is paid within 15 or 30 days. Or D, no discount is offered for early payment. So that phrase, 115 net 30, what does that mean? So make your choice. We'll leave it open for a minute or two. This one's going to go pretty fast this morning. Again, you can log directly into learningcatalytics.com. Just peek. Let's see. Okay. Just a minute. Okay. Okay, we're going to close the question in about a minute. I'm going to go over the answer now, so it won't close on your device quite yet. 115 net 30 means you get a 1% discount if you pay within in 15 days after invoice date, but you have to pay the entire invoice within 30 days if you don't pay within the 15. Okay, so as I said, that question will remain open for just a minute or two. What to do this week? This week we just have the Chapter 5 homework. That's in my accounting lab. Okay. Review your exam with Haley this week. She did see some people yesterday. She is also available today from 11 to 1. We get done with class around 10:30, 10:45 in that range, and we'll be going upstairs. She's there available. She is in room 579. So today we're going to continue this chapter, short-term investments and receivables. We talked about investments on Monday primarily, and then some revenue recognition with FOB shipping point, FOB destination, and the sales discounts, sales allowances. So our focus today is going to be on accounts receivable and then to some extent notes receivable after accounts receivable. So we're going to start this out with our second question of the day. Okay, so Scribbles, the coffee shop in Kent, purchases paper products on account from OfficeMax. Which company has an accounts receivable? And again, it's participation today. I will let you know if and when we go to accuracy grading on these. So Scribbles purchases paper products on account from OfficeMax. Which company has accounts receivable? The session ID is in the bottom of the screen if you're just getting logged in. Okay. Over 90% of you have this right, so that's wonderful. Leave this one open for a minute after I close it. So if you're just getting logged in, you have about a minute left, but I'm going to go over the answer. The answer is OfficeMax has an accounts receivable. OfficeMax sold the paper to Scribbles, so OfficeMax is owed the money, so it's accounts receivable. Scribbles is OfficeMax's customer. On the flip side, Scribbles has accounts payable because it owes OfficeMax for the paper. So in this chapter, we're going to be talking about accounts receivable. These are amounts that are due from our customers. Okay. So we're going to look at accounts receivable first. If we look, we're on Coca-Cola here quickly, and we're going to come back to Coca-Cola at the end. When we look at Coca-Cola's balance sheet, we see cash at the top, and then we see the investments. They have short-term investments, and then they have the marketable securities. And immediately below that, you typically find accounts receivable. And when we look at Coca-Cola's 10K, it says trade accounts receivable. And they're just saying, they just stuck the word in front of it, trade accounts receivable. Sometimes it's trade receivables, sometimes it's just accounts receivables. It just depends on the companies, but they're going to be something like that. So after we're done talking about receivables, we're going to come back to this 10K and see what else it means, because it says trade accounts receivables, receivable, less allowance of whatever. So what we're going to be doing real quick here is talking about what that allowance is, what it means, why we have it, and then we'll circle back to Coca-Cola's statement. Okay, so accounts receivable, just some things to note about it. Typically, accounts receivable is a company's third most liquid asset. Cash is always going to be first. And then you typically have your short-term investments. And then typically, this is not carved in stone, typically you see your accounts receivable. Once in a while, like if you look at Amazon's financial statements, I believe they show inventory third. So it's a close race for inventory or accounts receivable. Typically, you're going to see accounts receivable. Receivables are monetary claims against others. But it's basically, we get accounts receivable because we sell goods and services to our customers. And accounts receivable has to do with selling our goods, our services. Then we have something, notes receivable. And notes receivable, we're actually loaning money, and there's a promissory note. So notes receivable is a more formal document. Okay, so accounts receivable is typically our customers owe us money. Accounts receivable is a current asset. It's typically the third asset listed, and it's our customers owe us money. Notes receivable, we've loaned money. We have a promissory note, and we'll see towards the end of class we're going to go over notes receivable. But the first portion we're going to be talking just about pretty much focusing on accounts receivable, because accounts receivable, companies have to extend credit, and their sales will go up. They did a research study several years ago where they looked at people's buying habits if they had to pay cash versus if they could use a credit card. And people spent something like 3 times more if they had credit available. And the same thing goes for businesses. Businesses will be able to buy much more if they have credit extended to them. And credit is not a bad thing by itself. It's just when it gets out of hand, it's bad. Okay. Now, when we this isn't anything new. When we perform service on account, when we perform any service on account, we're going to debit accounts receivable, credit service revenue. If we loan money on a note receivable, we'll debit note receivable, credit cash. So we're debiting the asset to set it up when it initially happens, and then with accounts receivable, you'll see this credit to service revenue, and with notes receivable, typically you see a credit to cash. Notes receivable, that's what banks have. You go into a bank and sign a loan, they have a note receivable. Okay, so we have this accounts receivable debit, credit to service revenue when we sell something on account. That's a big entry. We're going to see it as we come up here. I want to do this now. Okay, so now we have a new term, and it's called subsidiary ledger. And so the full term is subsidiary ledger. And Okay, we have a general ledger, and a general ledger is where we keep track of all these accounts. So when we make a sale to a customer, we debit accounts receivable, credit, service revenue, and we post those amounts to the general ledger account. And on the left-hand side, that T account, that's accounts receivable. So all the activity we have to do with accounts receivable goes into the general ledger account. So we have a general ledger account for accounts receivable. Now, if that's all we had, we would never know at any given time how much each customer owes us, how much we've collected. So what we have is we have a series of subsidiary accounts, or subsidiary ledger. And what that does is it keeps track of the detail of the general ledger account. So let's say we have 3 customers in our example here. We have a total of 3 customers. We have Brown, FedEx, and Moody's. And I have a balance of $5,000 for Brown, $1,000 for FedEx, and $3,000 for Moody's. Now that's my subsidiary ledger. If I add those 3 amounts up, those 3 balances up, they will total my general ledger. So I have accounts receivable. That's what I will put in my financial statements. In my financial statements, we'll see that balance of $9,000. But privately, in-house, I need to know who owes me the $9,000. I need to be able to collect. So I have these subsidiary ledgers. These are not published in the financial statements, but they are the detail that say, here's the $9,000. Here's who owes it to us. And every time we get a payment, the payment is posted to accounts receivable, but it is also posted to the detail of the subsidiary ledger so that companies know who owes them what. It also is important to have a subsidiary ledger because companies' auditors come in. An auditor's job is to make sure that things are going according to policy, procedure, that our numbers represent reality. So the auditors, when they look at the $9,000 in accounts receivable, what do? They have to verify it some way. So what the auditors do then is they look at the subsidiary ledger, make sure all the balances of all the accounts in the subsidiary ledger total $9,000. But they're just relying on the company's numbers. That still doesn't prove anything. So then what the auditors will do is they will take those customers that are in the subsidiary ledger and they will contact them independently and say, how much do you owe this company? And that's called a confirmation. And what they're doing is they're verifying that that asset actually exists. Because if you just look at a financial statement and there's been no verification, it's the company's word that those accounts receivable really exist. Well, we have the subsidiary ledger that provides the detail, and then our independent auditor independently verifies that those amounts are true, that they actually are owed to the company. If there weren't rules, if there weren't verification and confirmation, we would be not able to rely on financial statements at all. We would be, and even when you look at companies now, you see fraud going on. And you think, what if we didn't have these controls? It would be like a big Wild West, and no one would be able to invest anything that they didn't have personal knowledge of. And that would be really limiting from a commerce standpoint. Okay, so subsidiary ledger is the detail of everything that's in the accounts receivable. This is not the first time we'll see subsidiary ledger. We do have subsidiary ledgers for accounts payable. We have subsidiary ledgers for property, plant, and equipment records. We have to, at any point when we have an account called equipment, we'll be able to go to the subsidiary ledger and see what all equipment we have. So subsidiary ledgers provide detail of the general ledger account. Okay, we'll get back to notes receivable. So what we're going to do now is accounts receivable. Accounts receivable, we extend credit. We extend credit because there's a benefit. Our sales will be higher if we extend credit. However, there is a cost to extending credit. Some people will not pay us. Okay? We weigh the benefit against the cost. Our sales are much greater with credit, hopefully, than the amount we lose for people that don't pay us. There will always be deadbeats. But what we try to do, what our credit policies are designed to do within an individual company, is minimize the amount of credit losses maximize your amount of revenue. So you've got this balancing act. If you extend credit to everyone in the world, your sales will be really, really high, but your losses from deadbeats will be really high as well. So you try to have this narrow range where you're extending credit to the most credit-worthy customers, your sales go up because of that, and you minimize your losses. But there is no way to completely eliminate deadbeats. And I call them deadbeats. I mean, things happen. Companies go out of business for whatever reason, and sometimes, inevitably, we will not be paid for accounts receivable. So that's what we're doing in this chapter. So we have something called the allowance method. The allowance method is what's generally accepted accounting principles. The allowance method says, okay, we know that of some of our sales, these accounts receivable will not pay us. We don't know which ones, so we have to estimate that. If we knew which ones, we wouldn't make the sale. So I'm going to pause for a minute because I see a lot of people writing down. So I'm going to pause. I'll be quiet for a minute, let you get caught up on writing, and then I'll talk about the rest of this. The allowance method says, okay, we want to match the bad debt expense with the period in which we have the revenues. So we want to make sure that when we make the sales, we recognize the amount of bad debt expense associated with those sales. We don't know which ones are going to go bad. They may not go bad for a year from now, but we need to recognize them now. So we have this method called the allowance method, and we estimate what percentage or what amount will be uncollectible based on past history. So companies will do things, they have lots of data. So they'll track their bad debts from the past, they'll track them and they'll track certain economic indicators, and they'll come up with some estimate of bad debts. So then what they do is they record uncollectible account expense. Uncollectible account expense is also known as bad debt expense. So bad debt expense, uncollectible account, they'll record it on the income statement in the period in which we made the sales. When we do this, we set up an account called allowance for uncollectible accounts or allowance for bad debts. So uncollectible accounts, depending on the company, might be allowance for bad debts, but they mean the same thing. So we have this allowance for uncollectible accounts. It is a contra account. It's a contra asset. It offsets, it's always paired with accounts receivable. And this is the amount the company expects to not collect. So we have accounts receivable. That's the total of everything everyone owes us that has not been paid to us yet. And that's an asset, and that has a debit balance. The allowance account is a contra asset, meaning that it is always shown with accounts receivable. It's the opposite of an asset. It is included in the assets, and it's a normal credit balance. So we have everything everyone owes us in the accounts receivable, and then we have hopefully the small amount sitting in the allowance account, and that represents what we're not going to collect. So when we show this on our financial statements, we're showing for net accounts receivable what we expect to collect. Because if we had accounts receivable of $1 million, but we knew we couldn't collect $500,000 of it, it wouldn't be right to show $1 million as our asset. We'll show the net of what we actually expect to show. So that's what's coming here. So we have allowance for uncollectible accounts. It's a contra asset, always, always, always shown with accounts receivable. So don't write this down. I just want to show you two different ways companies can show it. They can show it on the balance sheet as accounts receivable, and then right below that, less allowance for uncollectible accounts. Allowance for uncollectible accounts typically has brackets around it, and then you'll see the net amount, the 500 minus the 25. The 475 shows with the rest of the assets. So companies can show it like that. They can show both things. But what they're doing is they're showing an asset of 475 because that's what they can realistically expect to collect. We don't want to overstate our assets. The second way that companies can show this is they can show it as one line. And actually that's what we see with Coca-Cola. This is probably the more common. They'll say, oh, my asset is 475. That's what I expect to collect. But the line will say they have an allowance of 25. So what their gross accounts receivable is 500. It's the 475 plus the allowance. That'll get you to the gross. So they are actually owed 500. They're estimating they won't collect 25 of that. So their net asset is actually 475. Okay, what's their future economic benefit? The 475. They're probably not going to get the 25. This is all based on estimates because we don't know what the future holds. If we knew a certain party was not going to pay us, we wouldn't sell to them in the first place on credit. But we don't know, but we're trying to match the expense, the bad debt expense or uncollectible account expense, with the period in which we make the sale or we recognize the revenue. Yes? So the question is about how they get the uncollectible amount. Yes, they typically look at data. They have data for many, many years. And it was my experience in companies that I worked in, you could pretty well predict what it was going to be just because every year it would end up being like 2%. So they would look at historic trends, but then if the economy starts tanking, sometimes there's lead indicators that lead them to know that it's going to get worse and they can recognize extra. Actually, the banks recently, last year, started making their allowance less because as the economy improved, they were getting paid back better than they had during the recession. So now banks are making their allowance smaller so they can go. So they do watch. They watch past history, but they're also watching to see what's happening in the economy. Okay, now, so we use the allowance method. That is the method that's acceptable under generally accepted accounting principles. There are two ways to estimate how much is uncollectible. The first one is the percent of sales method, and the second one is the aging schedule. And again, I'm going to pause for a minute, let you write that down, and then I'll talk a little more about that. What's it? Okay, I'll just say it again. Again, the allowance for uncollectible accounts is the company's estimate of what they're not going to collect. That's what it is. It's saying this is how much we're guessing, or educated guess, of what we're not going to collect. Okay, so we have two methods. The first one, percentage of sales. This is the easy method. They say, typically they'll say, oh, 2% of our sales we won't see, we won't get back. So we'll take 2% of sales, for example. That's referred to as the income statement method. And that's referred to as the income statement method because we're taking the sales revenue on the income statement and figuring out a percentage of that. And percentage sales method, that's one way. It's the easy method. We're going to go through examples of these coming up. There's also the aging schedule, or this can also be referred to as the percentage of receivables schedule. And what this does is it says, based on how old the accounts are, meaning how past due they are, we're going to come up with an estimate of what our uncollectible percentage should be. And I'm going to show you an example coming up here of the aging schedule. But the aging schedule is known as the balance sheet method because we're looking at what people actually owe us. So we're looking at the balance of accounts receivable, and we're figuring out what that should be. How much of each of those invoices do we expect to be able to collect? So that's a balance sheet approach. The other one, the percent of sales method, is an income statement approach because we're saying of these sales, here's what we're not going to collect. They're a little bit different. The first one's the easier method. The second one, I don't think you'll have to calculate. It would be given to you. So I'll show you both of them. Okay, the first one, allowance method. The formula, pretty easy. You take your estimated uncollectible percentage, which you're given, times the sales revenue, and that gives you that expense amount. That's it. So that's the income statement approach because you're taking sales revenue times this percentage uncollectible, and this is where companies, put a lot of effort into estimating what that percentage is, but they come up with this uncollectible account expenses. Okay, so percent of sales, pretty straightforward. The aging method is a little more involved. And again, I don't know that we're going to collect it. We take the uncollectible percentage times basically accounts receivable. It's a little more involved than that. I'll show you on the next slide. But we're focusing on the asset on this one. On the percent of sales method, we're looking at the sales revenue. Here we're looking at the asset itself. Exhibit 5-3 shows an example of an aging schedule. So aging schedule, this is an example. You don't have to do the calculations, but you have to understand what an aging schedule is. An aging schedule, what a company does when they have an aging schedule is they take all their accounts receivable and they calculate how many days past the invoice date each invoice is, and they put it into reporting buckets. So in this example, this is I'll draw on the screen so you know what I'm pointing to. The allowance account balance, they're calculating, let's see, okay, their total accounts receivable is $11,028, okay? It's in millions, but $11,028 is their total accounts receivable right here, okay? Now, you don't need the equation. Let's just concentrate on this because you're not going to have to calculate it. Okay, so the total balance is $11,028. Now what they do is they take each one of the accounts receivable and put it into a column based on how many days past the invoice date it is. So the vast majority of these accounts right here fall in this 1 to 30 days past the invoice date. Okay, so they say, okay, 10,164 are in the 1 to 30 day bucket. And then they've got 600 in the 31 to 60 day bucket. And then they have 200 in the 61 to 90, and then over 90 days they have 64. So they've taken this 11,028 and spread it out over into each of these buckets, these time buckets of how far past due things are. And the reason they're doing that is they've done all kinds of research, and history shows that the longer something is past due, the less likely you are to be able to collect it. So then what they do is after they figured out how past due, they put it in these buckets of how past due things are. Then they use a percent uncollectible. So they say, okay, we have this percentage uncollectible. We say of a typical invoice that's just 1 to 30 days past its invoice, it's not even overdue at this point. We have shown that studies show that our own history shows 0.75% goes back. So they use that factor there. And then moving over to the next one, well, if they're overdue just a little bit, 31 to 60 days past invoice date, the uncollectability goes up a little bit, so we'll say 1% there. And then if the invoice is in that 61 to 90 day bucket, the likelihood that that's going to go bad is getting higher, so we'll use a 5% there. And then if it's more than 90 days past due, there's a much bigger likelihood we're not going to get paid, so we'll use a 10% factor there. Now, these percentages, the 0.75, the 1%, the 5%, and the 10%, those are percentages the company develops over time given its own history. So, and believe me, the credit departments, they know this information. And that's why credit departments are all about trying to collect early. We try to give early payment incentives to get as many people into that first bucket as possible because we want to get our money. The faster we get our money, the better likelihood that we're paid. So these percentages are given to us. In real life, the credit department has a lot of data to back this up, and they come up with these estimates. So what they're doing then with this is once they have the amount that's in that bucket and the percentage uncollectible, is they multiply the two things. So they're taking the total in each bucket, and they're multiplying. So they're saying, okay, let me take the 10,164 times the 0.75, and that's going to give me the 76, rounded roughly. Okay, and I'll do that with each of the buckets. So I'm taking each of the balances times that uncollectible percentage. That's why one formula for this aging schedule doesn't really mean anything. It's nothing you need because what they're doing is they're doing that for each of the time buckets. We're not going to be calculating an aging schedule because, I mean, it's fun to do if you're into numbers, but for our purposes, when we see it, what we're going to see is the result of adding all these buckets up, and we're going to be given $98. So what the 98, when they say, here's the 98, they're not saying this is our uncollectible account expense. They're telling us this is what the balance of the allowance account should be. The percent of sales method says this percent of revenues is bad debt, so we're going to just put that in allowance. This method says here's what the balance of the allowance account should be, and let's adjust the balance to be the 98. So this one's a little more involved than the other one, than the percent of sales. Where typically in here, we're going to focus on the percent of sales method because it's easier and we don't need to get stuck in the calculations. But know that this does exist. Of the two methods, which one's the more precise? Probably the aging schedule is probably a more accurate way to do it, but this is all based on estimates. So we use the allowance method. The allowance method says we have to come up with some way to estimate bad debts before accounts actually go bad. And the allowance method, there's two ways we can calculate or estimate it. We can estimate it using percent of sales or an aging schedule, otherwise sometimes known as percent of receivables. So we have those two methods. We're going to use one of them. Typically in here, we're going to use the percent of sales method. Okay, so let's do a couple questions, okay? The blank method records collection losses based on estimates developed from the company's collection experience. A, uncollectible, B, doubtful account, C, risk, D, allowance.
those numbers will run to the nearest million. The average of the formula that was running to the nearest million. That's not going to be exact.
Well, okay. So the question's about precision and going back at the end of the year. Let me address those two questions wound up in there. Number one, we were showing millions just because that's what we see as an outsider. These are absolutely kept to the nearest penny. Okay, so in records-wise, they are to the penny. It's just presenting to users. We don't need, that doesn't mean. So there's that. The second part, when you asked about do you go back and reconcile to what actually went bad, there can be a lot of overlap between years. And sometimes it might take someone a year to pay us. So we can't, there's not a precise way. But every year we're continually looking, the credit department's continually looking at their allowance to see if that makes sense or not. So they are constantly looking at it because the goal here is to make sure that your net accounts receivable represents what you truly expect to collect, regardless of how you calculate it. Yes. Okay, we're going to close this in 5 seconds or so. The blank method records collection losses based on estimates developed from the company's collection experience. Let me take a peek. Okay. This one will be the allowance method. The allowance method is what we've been talking about. It is the allowance method. We'll do 2 more. Okay, so our next one coming up here. Allowance for uncollectible accounts is classified as what? A contra expense account, a contra revenue account, a contra asset account, or none of the above. Okay, about 10 seconds left on this one. Think about when you answer this one, allowance for uncollectible accounts. What kind of account is it always paired with? Okay, that should be a good clue on this answer. Another 5 seconds or so. Don't yawn, Haley. Okay, and this is a contra asset. Okay, the allowance for uncollectible accounts is classified as a contra asset account. And then one more before we go on. The allowance for uncollectible accounts normally has a credit balance, true or false? Five seconds or so. Okay. Okay, and that's true. So we have accounts receivable, which is an asset, has a normal debit balance. Allowance account is a contra asset. It has a normal credit balance because it offsets the asset. Okay, now we've got some more terminology to get through. So far, and these terms kind of intertwine, and there's a couple terms coming up that seem like they're the same thing, but they're not. And you see them reported sometimes, so we need to make sure we know the terminology. We have something called write-off of uncollectible accounts. What we've done up to this point has been estimate our uncollectible accounts. So we estimate them using the allowance method. Now, once in a while, well, periodically, we find out that one of our customers who owes us money has, for example, gone bankrupt, and there is absolutely no hope of ever getting this money back. And that's where we have this write-off of uncollectible accounts. So here is our scenario that's set up, okay? And what we're going to be concentrating on here, what we're talking about, is this write-off. Again, remember that these slides are on, the PowerPoint slides are on Blackboard. Okay, so what we have here is we have accounts receivable, and we're just for the sake of simplicity assuming that we have 3 customers. So we have accounts receivable from customer RS of 9, accounts receivable of 3 from TM, and accounts receivable all other 11,016. So the allowance for uncollectible accounts that we've set up is 98. So those are the general ledger accounts, and our total accounts receivable then is 11,028, and where we get the 11,028, this is important, the terminology here. Okay, we take the 9, the 3, and the 11,016. We add all of those up, and that gives us the total accounts receivable. Now the net accounts receivable will be this total accounts receivable minus 98, then will get us down to the net accounts receivable of 10,930. So the 10,930 is what we expect to be able to collect. Now we have an allowance of 98. That is our estimate over time of how much of those assets we're not going to be able to collect. So that's all been done using the allowance method. There's our terminology. Where we see at the bottom, accounts receivable net. That is our net realizable value. You'll see that term. It would probably be worthwhile to write it down. It is net realizable value. Net realizable value is accounts receivable less the allowance. So it's accounts receivable less the allowance. Yeah, just a second. Would you type that in? Would you type in accounts receivable? Okay, so net realizable value is accounts receivable minus the allowance. And Haley's typing it in the chat room. Okay, so net realizable value, accounts receivable minus the allowance. That's how much you expect to be able to collect. The allowance is what you don't expect to be able to collect. Okay, so this is year end. The company has these 3 accounts receivable. They have net accounts receivable of 10,930. Keep that number in mind, because now we're going to get information. So this is now fast forwarding into the next year. And the company gets information that customer RS, that top customer, has gone bankrupt and cannot pay. Okay, so that 9,000 there, the company is not going to see. So let's go with new set of facts. Okay, so early in the next year, so we have this accounts receivable, we have net accounts receivable of 10,930. So early in the next year, the credit department determines that customer RS cannot pay the 9,000. Now, when we discover that customer RS cannot pay, we don't have any expense because we've already estimated it. We say, well, this 9,000 was part of what we estimated. So when we have a write-off, when we have the words write-off, write-off is a very specific term. Write-off refers to identifying specific accounts that aren't going to pay us. And we could leave them on the books, but what happens is we get this gigantic list of accounts receivable, and then we have this huge allowance account. When we write off an account, we're saying, this person's never going to pay us, let's get them out of there. So when we write off this RS account, what we're going to do is we're going to debit allowance for uncollectible account, credit accounts receivable. So what we've just done here is we've pulled it out of accounts receivable, we've pulled it out of the allowance account, and we are writing it off. It has zero impact on net accounts receivable. It has zero impact on assets. It has zero income impact. All we're doing is just taking it out of our list of customers. We don't have any expense associated with this because that $9,000 from this customer, that's part of what we estimated when we made that estimate of uncollectible accounts. Remember, we couldn't identify it. So we're saying, okay, well, this customer is not going to pay us. Let's just get them off the list of customers so it doesn't junk up, it doesn't obscure everything that is good. Let's get it out of there. So when we write off an account, we are saying this account's never going to pay us. Let's get it out of accounts receivable and let's get it out of the allowance account. Okay, so when we do that, what happens is we post that entry, so we debit the allowance for uncollectible accounts, we credit the accounts receivable, okay? Now down below are the general ledger accounts. We see that that 98 spaced wrong. The 98 should be up above that line. So what we're going to do then is the 9 is going to come out of the allowance for uncollectible accounts. The 9 is coming out of accounts receivable. Again, my spacing's off. And then we will have 0 accounts receivable from RS, and our allowance balance will now be 98. Okay, so this 9 is actually here. Okay, and then this 98. Okay. Okay, so after we do this, our accounts receivable will drop by 9. Our allowance for uncollectible accounts will also drop by 9. So what we're going to see then, if we go back to our T accounts then for this, we are going to see this accounts receivable here . Okay. These two, let's see. Okay, so these two wipe each other out. We have a balance of 0 from RS. Okay, so, and the allowance for uncollectible accounts, remember this 98 is just spaced, must be my computer. Okay, so we have 89. So my total accounts receivable, which is now my 0, my 3, my 11,016, that is going to be 11,019. Now my net accounts receivable is going to be the 11,019 minus the 89 gives us 10,930. So I have not changed my net accounts receivable. When we have a write-off of an account, it's identifying an account that's not going to pay us, so we just want to pull it out of allowance and out of accounts receivable. When we have a write-off, there is no income statement impact. So when you see a news article where a company is writing off a bunch of things, if they're truly using the word write-off correctly, there is no income statement impact. They should have been creating an allowance all along. Writing off is just taking it off their books, off their general ledger. Okay, so what we see on the balance sheet, and again, you don't have to write this down, is the balance sheet before the write-off, the net accounts receivable is 10,930. After write-off, it's still 10,930. We're just shifting, we're taking it out of allowance and out of accounts receivable at the same time. Okay, we're going to do one question, and then we are going to do a homework problem. There's a question, I'll address this. We put the question up, and I'll answer that question, Haley. The net realizable value of accounts receivable is the difference between accounts receivable and what? There's a question in the chat room. So writing off will not affect asset account at all. What, I assume that's if the debt of the account exceeds that of the allowance. That's beyond the scope of our class. If you have a customer that large that exceeds your allowance, that would require another entry. So you're going to make an adjustment. That's not going to typically happen because you won't be caught that much off guard. Your allowance is typically much bigger than any one account. But if it happens, you have to make further adjustments. Okay, the net realizable value of accounts receivable is the difference between accounts receivable and what? Yes. Can you see the screen? Put it in the chat room again. You want to come on down? Yeah. You want to? I don't have any way to. Yeah. Can you see that one up there? Can you see it? Got it? Yeah, you can write it around on the bottom. That's okay. If we have a marker that works. Okay. I'm going to go through the answer. I'll leave it open for about 10 more seconds, so Haley, wait till I get to the homework problem. The net realizable value of accounts receivable is the difference between accounts receivable and the allowance for uncollectible accounts. When we talk about the net realizable value, it is accounts receivable minus the allowance. That's what gets us to the net realizable value. So I would definitely know what net realizable value is. Okay. Now we're going to do short exercise 5-8. 5-8, we're just going to do a couple quick entries. We have a company that has, a chocolate company that has its first year of operations. It had sales of $483,000, all on account. So they made all their sales on account, and industry experience suggests that the chocolate company's uncollectibles will amount to 2% of credit sales. Okay, and credit sales, they're just referring to those sales that are on account. At December 31st, accounts receivable totals $49,000, and the company uses the allowance method. So the first requirement is make the journal entry for uncollectible account expense using the percent of sales method. Okay, so we're just going to do the journal entry for the uncollectible account expense. What we're going to do is we'll take the credit sales of $483,000 times 2%, so we get $9,660. We'll debit uncollectible account expense and credit allowance for uncollectible accounts. So we're debiting the uncollectible account expense. What's happening here is we're recognizing expense. We're saying we estimate that of all these sales we made, we won't collect $9,660. And then we're crediting that allowance for uncollectible accounts, which it decreases assets. So we're increasing expense, decreasing assets. So whenever you do an entry to estimate uncollectible accounts, you're always going to debit the uncollectible account expense and always going to credit the allowance account. So this entry right here, as you go on in, if you're an accounting major and you go on to corp accounting, there'll be other things you do during this entry as well, but for our purposes, this entry is always going to look like this. Okay, so that was the first requirement. The second requirement says show how they should report accounts receivable on its balance sheet. So what we're going to see on the balance sheet is we'll have accounts receivable less the allowance for uncollectible accounts gives us net accounts receivable. Okay, so you're going to show that allowance somewhere because it is important for investors to be able to see what your allowance is, but you're going to show the net realizable value there. Okay, so that does it for that exercise. We have one more term associated with accounts receivable. We said that writing off an account meant that we were just simply taking it out of accounts receivable and out of allowance. And then we had used this allowance method to estimate our uncollectibles. There's one more term that falls very closely with all those, but it's different, and it's a big difference. And this term, the next term, is called direct write-off method. And basically, the direct write-off method, and this is important to use that word direct. Direct write-off method says, to heck with this, we're not going to do any estimates, we'll just wait until a customer declares bankruptcy and then we'll write it off. And that's known as the direct write-off method. This is not generally accepted accounting principles. The reason being is you can have all kinds of sales. You make sales to anybody. You extend credit to everybody. Then you have this huge accounts receivable, and if you don't have any allowance, you're overstating your assets. So this is not generally accepted accounting principles. Assets will be overstated with it, and you don't recognize expense in the period in which you have the revenue. So there's all kinds of things wrong with it. So it is not acceptable for generally accepted accounting principles. However, on the other hand, it is the required method for income tax purposes. So this is, again, why your federal income tax return is not a financial statement. It is what you report to the government. It's based on their rules, but it's not grounded, your federal tax return is not grounded in being a good informational tool. So we are not going to do the direct write-off method in here. You need to know the direct write-off method is not acceptable for generally accepted accounting principles, and it just involves, there's no estimates involved. You wait until someone goes bankrupt, and then you write them off. Okay. Okay, so we're going to circle back briefly, look at Coca-Cola statements, and then we're going to go on to notes receivable. This is not a question. Go backwards. Okay. Coca-Cola's balance sheet. So now we're back at Coca-Cola's 10K. When we look at their 10K, they list trade accounts receivable, and that's great. They're just calling it trade accounts receivable, meaning that it comes up, they have this accounts receivable because it comes up in their ordinary business. Now it says less allowance of 61 and 53 respectively. What that means is they have an allowance for uncollectible accounts of 61 for 2013 and 53 for 2012. So what we see here then is if I take their 2013 balance of net trade accounts receivable, 4,873, and I add the allowance of 61, that gives me their gross accounts receivable. I'm just referring to it as not netted. So what they have for accounts receivable on their books would be the combination of those two things added together. So this is what they have in accounts receivable. They have this allowance set up for 61 as of the end of 2013. So that's showing you what they think they will not collect. Now going further, that was their balance sheet. Now we look at their notes to their, I guess I didn't highlight anything. Okay, their notes to their financial statements. So this is one of the notes. It's called trade accounts receivable. If you look at anybody's financial statements and they have accounts receivable, they're going to have a note in there about it. So it tells us that we record trade accounts receivable at net realizable value. That tells you that they're using the allowance method. They've got an allowance account and they're showing you net. So it says this value includes an appropriate allowance for estimated uncollectible accounts to reflect any loss anticipated on the trade accounts receivable and charged to the provision for doubtful accounts. So they call their allowance for uncollectible accounts provision for doubtful accounts, and that's fine. There's a little bit of different terminology running around here and there. We calculate this allowance based on our history of write-offs, the level of past due accounts based on the contractual terms, and our relationships with and the economic status of our bottling partners and customers. Okay, so they're telling you they use history, they use economic indicators to come up with this estimate. And then down below there it tells you the balance of the allowance for doubtful accounts at the beginning of the year. It tells you the net charges, how much they wrote as their adjusting entry, and then they have write-offs, and that's reconciling all of this for them. So they're giving you this information that we just looked at. So Coca-Cola is using U.S. GAAP, which you would expect, to account for accounts receivable. So we see that on their financial statements. And then when you see the uncollectible account expense, because they obviously had it, they've written some off, on the operating, on the statement of income, on their income statement, you would end up seeing that on the income statement, it's going to be buried in there. It doesn't have its own line, but you know from looking at this statement, it's telling you the net charges to costs and expenses. So you don't see the net charges on the income statement. It's too consolidated for that, but it will be in there. Okay, so that brings us to our last concept in the chapter, and it's notes receivable. Notes receivable are you have a promissory note. So accounts receivable, the companies offer accounts receivable in the ordinary course of business, and you pay them and you're done with it. Notes receivable, you've loaned money or you have a promissory note and interest is involved. You have to pay interest on notes receivable. Notes receivable, you receive interest. If you have a note payable, you pay interest, but they're mirror images. Okay, so we have we're not going to go through. I would advise you to go through. You're not going to be able to write this fast. But notes receivable, we have terms. We have the creditor, the party to whom money is owed. This is the lender. All these terms are in your book. This slide is in the PowerPoint slides for the chapter. We have the debtor. This is the maker, the borrower. That's the party that borrowed the money. We have interest, and we know what interest is. Interest is what we have to pay for borrowing money or what we receive for loaning money. It is stated as an annual percentage rate. So when we see an interest rate, it's an annual rate. We have a maturity date. That's the date on which the note must be paid. The notes that we look at are due to be paid on the maturity date. They are not installment notes. It's not a note. We do have installment notes, but not in this class. An installment note means you'd make like a car payment every month. These are, we have a note and it comes due 6 months from now. Maturity value is the sum of the principal and interest. So what we're going to get at maturity, at that due date, we're going to get what we loaned and we're going to get the interest. Those combined are the maturity value. And then we have the principal, which is the amount borrowed by the borrower, and then the term. Okay, and this is, it can be 3 months, it could be a month, a 90-day. We're going to see, for our purposes, they're going to either be number of days or more commonly number of months. So if it's a 90-day, if it's a 3-month note, we use 3 months. So we don't, you'll see as we go. I think what we're going to do right now is we're going to dig right into a homework problem. We are going to circle back, I think. Okay, so we're going to go through notes by looking at an actual note. I think that makes the most sense. Okay, so short exercise 511. We have a note. We have a note receivable. On May 31st, Main Street Bank lent $220,000 to Ron on a 2-year 5% note. Okay, so there is May 31st, the bank loaned money, and they loaned $220,000 to Ron on a 2-year 5% note. So we have to compute the amount of interest during 2014, 2015, and 2016. The note was made on May 31st, 2014. So this note goes for 2 years, so it's going to go into 2016. So requirement 1 is to compute the amount of interest during each of those 3 years for this note. So let's go through the computations. The first year, 2014. Okay, during 2014, we are going to have interest. Now, to calculate interest, we would take the note amount. So the note amount is $220,000 times 5%. That's an annual rate. Now, that would give us the amount for the entire year. However, this is not the entire year. We loan the money on May 31st. We do not count the day you loan the money, so it starts the next day. So we have June through December. And the biggest issue I see on these problems is people don't count the months right. And if you have to, count them on your fingers. And sometimes I have to go through the months and count how many months there are. So in this case, May 31st, May doesn't count, so we're talking June through December. June through December is 7 months. So what we're going to do for the interest for 2014 is we're going to take $220,000 times the 5%. That person needs to contact tech support, and then I need a Okay, so 2014 interest is going to be $220,000 times 5%, then times 7 months out of 12, because this is June through December. So June through December, it's going to be 7 months. So $220,000 times 5%, that annual rate, times 7 months out of 12. So the interest for 2014 is going to be $6,417. When you're doing your homework, I'm pretty sure you run to the nearest whole dollar. The rounding instructions will be on your screen somewhere above where you put the answers. It's typically in a different color, and it's italicized, so there's 2 ways you can look for it. If you ever have any doubt about it, click on the Help Me Solve This, and you'll see what the answer should look like as you cycle through. Use the 5-4 rule. Most of you know that, but every semester I get questions. The 5-4 rule is if it's 5 or higher, you round it up. If it's 4 or lower, you round it down. Okay, so 2014 interest is $6,417. Okay, so then something with the computer then. Okay, so 2015 interest is going to be for the whole year because this is a 2-year note. So $220,000 times 5%. There is no adjustment because we're holding it for the entire year. And then finally in 2016, this is being paid off May 31st at the end of, it's due in 2016. So 2016 interest, we have $220,000 times the 5% rate times the 5 months. We hold it 5 months in 2016. It's not due till May 31st, so we hold it for January, February, March, April, May. So 5 months. So the interest in 2016 will be the $4,583. Okay. when we're dealing with a 2-year note or 3-year month, you don't worry about like a day adjustment. You don't do this based on days. You only do it based on days if it's listed as a 30-day note. And even then, it's usually safe to do it on a month, well, days. So if it's listed as a 3-month note, a 6-month note, a 2-year note, do months. Okay, you're not going to split hairs with number of days. Okay, which party has a notes receivable, or Blackboard Collaborate is the better tech support for that. Okay, which party has a note receivable? And there's a chat window for Blackboard Collaborate help that they can get help right then. Okay, which party has a note receivable? So we have the bank and we have Ron. Yes. Oh, okay, yes, the bank has a note receivable. And then on the note payable then has to be Ron. Note payable, and then who has interest revenue? That will be the bank. And then Ron, interest revenue is the bank. Interest expense is Ron. Now, the last part of this question, how much in total would Main Street Bank collect if Ron paid the note off early? So the note is made May 31st, 2014. In this question, it's asking how much would the bank collect if Ron paid the note early on November 30th. So what Ron's going to pay on November 30th is he will pay the principal of $220,000. He will also have to pay interest, and he pays interest for 6 months. Why 6 months? It would be June, July, August, September, October, November. So we have 6 months of interest. So it's a $220,000 times 5% annual rate times the 6 months divided by 12. So you're always the number of months divided by 12. And so that gives us interest of $5,500. So the total payoff on November 30th would be $225,500. And I think that brings us to the end of class for today. I will be sending out an email with a couple more step-by-step videos for a couple homework problems in case you want help on those. So have a nice weekend. I guess it's supposed to snow today, right? Yay!